The silver crash from $121 to $64 was not a market failure. It was a mechanical trap. Most people believe the bubble popped. The headlines scream meltdown, panic selling, retail greed meeting gravity. That is the official story, you see. The data tells a different script. The crash began on January 30th, 2026. Silver had reached $120.565 just 24 hours earlier. Then the floor vanished, 31% gone in a single session. The price hit $78.53 by close. But here is what the headlines buried. 3 weeks earlier, on January 7th, the CME Group raised silver maintenance margins to $32,500 per contract. That is a 47% increase in 1 week. You see, margin is the leverage valve. When the CME tightens it, traders using borrowed capital face a binary choice: post more cash or liquidate immediately. Which means this was not a collapse. It was a forced liquidation event. The math is surgical. Most silver futures traders operate at 15-to-1 or even 19-to-1 leverage. A 5% drop in price triggers automatic margin calls. A 10% drop creates a cascade. The January 30th event was a 31% waterfall in hours. The mechanical outcome was inevitable. Plus, the real story is not the crash. The real story is what happened after. Today, I'm breaking down the 3-stage divorce now happening in the silver market. Stage 1, the margin purge that flushed paper traders. Stage 2, the great divorce between New York futures and Shanghai physical. And Stage 3, the vaporization of registered inventories that makes the next move mathematically certain. A mandatory protocol before we open the file: this is not financial advice. I am not a licensed advisor. The math follows a script, but your capital is your responsibility. Always conduct your own research. The New York silver market and the Shanghai silver market are no longer pricing the same asset. By early February 2026, silver stabilized around $70 in New York. Analysts now call this the industrial value bottom. The new normal, but in Shanghai the story is different. Physical silver is trading at an $8 per ounce premium over the New York paper price. You see, premiums are the fingerprint of scarcity. When physical metal is abundant, premiums are tight, $1, maybe $2. But when vaults are empty and industrial demand is accelerating, premiums explode. $8 is not a premium. It is a warning signal, which means Shanghai buyers are paying $78 for the same ounce New York claims is worth $70. The paper market says there's plenty of supply. The physical market says the metal is gone. This is the great divorce. The system is splitting into two realities. Paper silver, traded on leverage in New York and London, is a financial derivative. Physical silver, moving through Shanghai and Hong Kong, is a scarce industrial commodity required for solar panels, AI server infrastructure, and military-grade electronics. Plus, the divorce is accelerating. China restricted silver exports on January 1st, 2026, under announcement number 68. Only 44 state-approved companies are allowed to ship silver outside Chinese borders. The licensing requirement mandates a minimum annual production of 80 tons. That single rule eliminated 95% of previous private exporters. You see, this is not trade policy. This is strategic hoarding. The United States Geological Survey added silver to the critical minerals list on November 6, 2025. For the first time in history, silver is now classified alongside lithium, cobalt, and rare earth elements as essential to national security, which means both superpowers are treating silver like a weapon. Your portfolio is caught in the middle of a supply war disguised as a market correction. The paper price crashed because leverage was flushed. The physical price is rising because the metal itself is vanishing into sovereign vaults and industrial stockpiles. Most people will ignore this data and pay the price. But if you are the type of person who refuses to be a victim of the mechanical script, join the forensic circle by hitting subscribe. We hold ourselves to a different standard here. But even this great divorce is a surface-level symptom. The real mechanism, the one that makes the next phase inevitable, is hidden in the London lease rate data and the backwardation crisis now appearing in the futures curve. That is where the mathematical trap closes. The January 30th crash was not random. It was engineered by a leverage ratio that guarantees liquidation cascades. Here is the mechanism. Most silver futures contracts on the COMEX are traded at 19-to-1 leverage. That means for every $1 of actual capital, traders control $19 of silver exposure. You see, leverage is a mathematical amplifier. It magnifies gains on the way up, but it also magnifies losses on the way down. A 5% drop in the silver price does not just erase 5% of your capital. It erases 95% of your margin cushion, which means when silver falls 5%, traders operating at 19-to-1 leverage receive margin calls. They must post additional cash immediately or their positions are automatically liquidated by the exchange. This is not a choice, it is a protocol. Plus, the liquidation itself creates additional selling pressure. The exchange sells your contract into the market to recover the borrowed capital. That sale pushes the price lower, which triggers more margin calls, which creates more forced selling. The cycle feeds itself. On January 30th, silver dropped 31% in a single session. At 19-to-1 leverage, that is a complete wipeout for anyone who entered the market in the previous 72 hours. You see, the CME Group controls the margin requirements under Rule 802 and Chapter 7 of their rulebook. The fine print is explicit. The exchange can change margin requirements at any time, without prior notice, to protect the financial integrity of the clearinghouse, which means the exchange has absolute discretion to raise the cost of leverage whenever bullion banks or institutional participants face exposure risk. The January 7th margin hike was not a risk management decision. It was a preemptive strike. Your retail stop loss did not save you. The professionals knew the margin trap was coming. They exited before the hike. You were left holding a leverage contract that became mathematically unaffordable overnight. The waterfall was mechanical. The timing was deliberate. Now we move to the physical market. This is where the crisis becomes visible. On February 6, 2026, the one-month London silver lease rate spiked to 6.3% annualized. You see, a lease rate is the cost to borrow physical silver from a vault. When the lease rate is low, it means there is plenty of metal available. Banks and dealers can borrow silver cheaply to hedge their short positions or fulfill delivery obligations. Anything above 1% is unusual. Anything above 3% is a crisis. 6.3% is a 5-alarm fire, which means the vaults in London are running dry. The cost to borrow silver has exploded because there is not enough physical metal available to satisfy current demand. Plus, this is the highest lease rate since the silver squeeze of 2021, when retail traders on Reddit attempted to corner the physical market by buying every available ounce. Back then, the spike lasted 2 weeks before inventory stabilized. This time, the spike is occurring while registered COMEX inventories have already fallen more than 70% since 2020. You see? Registered inventory is the silver that is available for immediate delivery. It sits in approved warehouses and can be claimed by futures contract holders who stand for delivery. 70% of that inventory is gone, which means the London lease rate is spiking because there is no backstop. The vaults that once supplied the market during stress events are now empty. The bullion banks that used to lend metal at low rates are now charging crisis-level premiums because they do not have the physical silver to lend. Your paper contract says you own silver. The lease rate data says the metal does not exist. Here is the smoking gun. Every 1 ounce of physical silver currently held in registered COMEX inventories carries approximately 20 times the paper commitment. You see, the COMEX operates on a fractional reserve model. Most futures contracts are closed before delivery. Traders buy and sell contracts for profit. They never actually take possession of the metal. A system depends on this behavior. But the math has limits. If even 5% of contract holders decide to stand for delivery and demand physical silver, the exchange does not have enough metal to fulfill those claims, which means the entire futures market is a leveraged bet on the assumption that you will never ask for your silver. Plus, the divergence is now visible in the futures curve itself. New York silver futures for July 2026 are currently trading lower than the London spot price of $76.65. This is called backwardation. You see, in a normal market, futures contracts for delivery months further out in time trade at a premium to the current spot price. This reflects storage costs, insurance, and the time value of money. But when futures trade below spot, it means the market is pricing physical silver as more valuable today than it will be in 6 months, which means the market is screaming that physical metal is missing right now. Backwardation is the fingerprint of a supply crisis. The July contract should be trading above the current spot price. Instead, it is trading below. The market is telling you that if you want silver, you need to pay a premium to get it immediately. Because there is no guarantee it will be available in July, your futures contract is supposed to give you the right to silver at a future date. The backwardation data says that right is worthless because the metal will not be there when you try to claim it. Now we return to the exchange itself. The CME Group has the legal authority to suspend delivery, impose position limits, or even cash settle contracts if a delivery default threatens the integrity of the clearinghouse. You see, Rule 802 gives the exchange unilateral power to modify contract terms in the event of a market emergency. Chapter 7 grants the clearinghouse the right to substitute cash payments for physical delivery if the metal is unavailable. Which means, even if you hold a valid futures contract for physical silver, the exchange can simply pay you the cash equivalent and close your position. You do not get the metal, you get a check. Plus, the exchange defines what constitutes a market emergency. There is no external audit, no independent review. The decision is made by the same institutions that are short the metal. You see, the bullion banks that trade on the COMEX are also the entities that hold short positions in silver. They have borrowed metal they do not own and sold it into the market to suppress the price, which means the same institutions that owe you silver are the ones who control the rules of the game. The January 7th margin hike protected their exposure. The backwardation in the futures curve exposes their inventory crisis, and Rule 802 gives them the legal mechanism to default on delivery without consequence. Your contract is not a claim on silver. It is a claim on the good faith of institutions that are mathematically trapped. The leverage waterfall flushed retail traders. The London lease rate spike confirms the vaults are empty. The backwardation proves physical silver is missing, and the CME rulebook gives the exchange the authority to terminate your claim whenever the math becomes inconvenient. This is not a market. This is a controlled demolition. The question is not whether the system breaks. The system is already broken. The question is whether you are positioned in physical metal when the paper walls finally collapse. On January 1st, 2026, China implemented Announcement Number 68. The regulation restricts silver exports to only 44 state-approved companies. The licensing requirement mandates a minimum annual production of 80 tons. You see, 80 tons is not a small threshold. It is a deliberate barrier designed to eliminate private participation, which means 95% of previous silver exporters in China were purged overnight. This is not trade policy. This is the transition to a state trading regime. Plus, the timing is surgical. China announced the restriction on the same day the global silver market entered the highest volatility period in 5 years. You see, when a government restricts exports of a commodity, it sends a signal to the market. We believe this asset is more valuable inside our borders than outside, which means China is hoarding silver. The official justification is environmental compliance and quality control. The fine print reveals a different script. Only companies with state backing, strategic reserves, and approved trade relationships are allowed to move silver across Chinese borders. Your access to Chinese silver just vanished. Plus, This is not the first time China has weaponized export restrictions. In 2010, China restricted rare earth exports and watched the price of neodymium and dysprosium explode by 400% in 18 months. You see, the pattern is repeating. Restrict supply, watch the West panic, accumulate strategic reserves while the price is suppressed by paper markets. Which means the China export purge is a geopolitical calculation disguised as regulatory cleanup. The Shanghai Futures Exchange inventory dropped to 349.9 metric tons by February 6, 2026. That is a fraction of its former levels, you see. 349 tons is roughly 11 million ounces. The global solar industry alone consumes more than 130 million ounces of silver per year, which means the Shanghai vault contains less than 1 month of solar demand. Your supply chain is running on fumes. On November 6, 2025, the United States Geological Survey added silver to the critical minerals list for the first time in history. You see, the critical minerals list is not a casual designation. It is a legal framework established under the Energy Act of 2020. The list identifies materials essential to national security, economic stability, and technological infrastructure, which means silver is now classified alongside lithium, cobalt, rare earth elements, and uranium. Plus, the designation unlocks government subsidies, streamlined permitting for domestic mining projects, and the legal authority to impose export restrictions if supply is threatened. You see, the United States does not add commodities to this list unless there is a strategic vulnerability, which means the U.S. government knows the silver supply chain is broken. The timing is critical. The USGS designation occurred 6 weeks before China implemented announcement number 68. The U.S. government saw the export purge coming and preemptively classified silver as a national security asset. Your government is preparing for a supply war. Plus, domestic use silver production is negligible. The United States produces roughly 1,000 tons of silver per year. Domestic demand exceeds 5,000 tons annually. You see, the gap is filled by imports. Most of that imported silver comes from Mexico, Peru, and China, which means when China shuts the valve, the U.S. supply chain fractures. The critical minerals designation is not a solution. It is an admission of dependency. Your industrial base is now competing with sovereign governments for the same scarce metal. This is not the first time the silver market has been destroyed by a margin hike and liquidation cascade. March 27, 1980, Silver Thursday. Silver had climbed to $50 per ounce as the Hunt brothers attempted to corner the physical market. The COMEX raised margin requirements. Leveraged positions collapsed. The price fell 65% in 4 days. You see, the Hunt brothers controlled an estimated 130 million ounces of silver. They used futures contracts and physical accumulation to drive the price higher, which means the exchange responded by changing the rules mid-game. The COMEX implemented Silver Rule 7, which restricted new long positions and forced liquidation of existing contracts. The Hunt brothers were wiped out. The price crashed from $50 to $10 in less than 2 months plus. The crash did not happen because supply increased. It happened because the leverage was removed. You see, the same mechanism was deployed in 2011. Silver reached $49.8 per ounce in April. The CME raised margins 5 times in 8 days, which means the price collapsed 35% in 2 weeks. The pattern is identical. Silver rallies on physical demand and retail speculation. The exchange raises margin requirements. Leveraged traders are flushed. The price crashes. 1980, 2011, 2026. The script does not change. You see, the 40% correction from $121 to $70 follows the exact playbook used twice before in modern history, which means this is not a market failure. This is a controlled reset. Plus, there is one critical difference between 1980, 2011, and today. In 1980, global silver inventories were abundant. The Hunt brothers were cornering a market with plenty of physical supply. In 2011, industrial demand was rising, but vaults were still full. The crash was painful, but temporary. In 2026, registered COMEX inventories have fallen 70%. London lease rates are at 6.3%. Shanghai vaults are down to 349 tons. And both the United States and China have classified silver as a strategic asset. You see, the previous crashes occurred in markets with supply. This crash is occurring in a market without it, which means the leverage flush worked. The price collapsed, but the physical shortage remains. The difference is mathematical. In 1980 and 2011, the system could recover because the metal existed. In 2026, the metal is gone. Your paper contract crashed with the leverage. The physical premium in Shanghai is rising because the vaults are empty. Empires do not collapse because of external enemies. They collapse because of internal arithmetic. Rome debased the denarius. Spain inflated the peso. Britain abandoned the gold standard. The Soviet Union printed rubles until the currency was worthless. You see, the pattern is always the same. Expand the money supply. Suppress the price of hard assets. Drain the physical reserves. And when the gap between paper claims and physical inventory becomes too wide, the system fractures, which means the silver market is not unique. It is following the script written by every empire that came before. The United States and China are now competing for the same scarce metal. Both governments have implemented strategic frameworks to secure supply. Both governments know the paper market is a lie. Plus, the math is accelerating. Solar demand is projected to consume 165 million ounces by 2030. AI server infrastructure requires silver for thermal management. Military electronics depend on silver conductivity. You see, this is not a speculative bubble. This is an industrial supply crisis disguised as a financial correction, which means the cycle dictates the outcome. The leverage will be flushed, the weak hands will be shaken out, and the physical metal will flow to the entities that understand the script. Your government knows. The Chinese government knows. The question is whether you know. The floor is now $70. Major institutions, including Citigroup and JP Morgan, now view $70 as hard support. Not because of technical analysis, because of industrial demand. You see, artificial intelligence server infrastructure requires silver for thermal management. Solar panel production consumes 130 million ounces annually and rising. Military-grade electronics depend on silver conductivity that no substitute can replicate, which means $70 is not speculation. It is the price required to incentivize new mining production while meeting baseline industrial consumption. Plus, if the gold-to-silver ratio reverts to its historical bull market peak of 32-1, and gold remains at $5,000, the mathematical target for silver is $150. You see, the ratio has hit 32-1 twice in modern history. 1980 during the Hunt brothers rally. 2011 during the sovereign debt crisis, which means the precedent exists. The math is not theoretical. Most people will ignore this data and pay the price. But if you are the type of person who refuses to be a victim of the mechanical script, join the forensic circle by hitting subscribe. We hold ourselves to a different standard here. The leverage waterfall flushed the weak hands. The margin trap worked exactly as designed. The paper price collapsed from $121 to $70 in 30 days. But the physical shortage remains. China restricted exports. The United States classified silver as critical. London lease rates hit 6.3%. Shanghai vaults are nearly empty. And the backwardation in the futures curve proves the metal is missing right now. You see, the crash was mechanical. The recovery will be mathematical. The question is not whether silver recovers. The question is whether you are positioned in physical metal when the paper walls finally vanish. The file is closed.